Some individuals are highly reliant on the stock market to consistently increase in price every single year. Unfortunately for them, this year has not been kind. This is the first year in a decade that the buy the dip strategy hasn't worked. 90% of assets have negative returns in 2018, and that is usually what you find in a bear market. There's just one problem. The government hasn't admitted it yet. You came here for the truth, so let me unveil that for you. Today we're going to look at the different asset classes. I want to show you the markets. I want to show you all the details that you need to know. This is going to be a very concise video. I'm going to try to bring this several charts and articles I have as fast as I possibly can. Let's get into the details, beginning with the markets themselves. The S&P 500, NASDAQ, and the Dow Jones all in positive territory today, all in the green. You can see the Dow Jones had risen 354 points for the day. The NASDAQ is up 2% and the S&P is up as well. In the beginning of the day, the market started off entering into positive territory. It started to slip in the middle of the day, but throughout the afternoon it came back. And this is interesting because what happened last week was that the markets were actually in the negative, and that was strange because in this time frame after Thanksgiving, you usually have positive response to what's going on. The individuals, they're shopping, they're buying. Now is going to be the busy time for retailers. It's always so positive, but all the tensions, all the escalations, all the rhetoric that has been built up this far is only becoming worse, and that showed up in the stock market last week. Now today, very unusual that it was in the positive, and I'll get into that more in just a second, but hang on to that thought. What we're looking at here is the stock market fluctuating wildly day to day. Nobody really knows what the case or what the reasons are oftentimes, but here we are. All we need is a tweet coming from one direction or a meeting of two individuals in another direction, and the market can move twice in one day. It is completely unusual to see this. Now, Jim Bear Stearns Cramer said this, and I actually, believe it or not, agree with him. I have tremendous contempt for this market. It's a bear market, not a correction. Can you believe it? Jim Bear Stearns Cramer is talking about this. People don't want to call it a bear market, but what do they need? I have tremendous contempt for this market because every time you try to make money with it, it cuts your heart out. That's a bear market. So in the way that he's saying it, it's definitely true because there are certain fundamentals which, government statistics they provide that should be holding this market up very high, and yet the market falls. That's when you know you have that negative sentiment underlying all of the statistics that we are basically handed. After tanking nearly 3.8% last week, the S&P 500 recovered nearly a third of that decline shortly after Monday's open on Wall Street. We saw that in the previous, I just showed you. Cramer on Monday's stock surge talk about classic bear market behavior. Jim Cramer says that the market is displaying, quote, classic bear market behavior. We crater all week and then we open up huge on nothing, but because we are so oversold. Now that's what you need to understand. The market went up a fairly significant amount, 350 points on the Dow. And why? Nothing really. There was no reason. Friday wasn't good. Last week wasn't really good. And since the beginning of October, it's been terrible. So why did the market come up? Well, there's really no reason other than the market is oversold and people are buying in. That's the buy the dip strategy, and that has not been successful at all throughout 2018. And look, a month left and we're done. We're in 2019. That is not a strategy right now, but that's what people are doing. And this is not going to be good for those people who are pouring their money in. Look at this, GE. GE was one of Wall Street's major share buyback operators between 2015 and 2017. It repurchased $40 billion of shares at prices between $20 and $32. The share price now is $8.60. So the company has liquidated between $23 billion and $29 billion of its shareholders' money on this utterly futile activity alone. Share buybacks are not always positive, and that's what you need to understand. GE is a perfect example example of that. Yes, obviously it's just one example, but this could happen to many more companies. Since the highest net income recorded by the company during those years was $8.8 billion in 2016, with 2015 and 2017 recording at a loss, it has managed to lose more on its share repurchases during those 3 years than it made in operations by a substantial margin. That shows you how reckless share buybacks can be. But you're not going to hear that in the mainstream. You're not going to hear Warren Buffett do that. He's going to eat his popsicles, he's going to drink his Coca-Cola, and he's going to convince everybody that what he's doing at any given moment is always the right thing. I'm not trying to say that he's doing something right or not. I'm just showing you the way it is. This is one perfect example of that situation that I'm sure we'll be referring to in the coming years. There's more detail in there if you want to read it, but look at this. Under pressure, a record share of asset classes has posted negative total returns this year, according to Deutsche Bank, going back to 1901. That means throughout 1929. That means all throughout the 70s. That means everything that happened with the dot-com, the financial crisis, and yet today we've exceeded that. Everything is correlated today, more so than in 1929, if that's possible. Think about what that means for the markets and the negative aspects of that. Many people don't want to believe it, but that's the absolute fact. Percentage of assets with a negative total return in USD, that's on the left, and local currency on the right. In USD, 90% exceeding all that before it throughout the 1900s up until today. We have a very big problem, and that is not going to be resolved by quantitative easing. It's not going to be resolved by quantitative tightening. It's not going to be resolved by any strategy that we've been provided with other than simply allowing the market to naturally fall down. Do not rescue it. Let the companies go bankrupt and pick up the pieces where they fall. That's not going to be allowed to occur, and so we can expect a more disastrous outcome in the long term. I'm not allowed to talk about that because people get scared, so let's move on to this. No refuge for investors as 2018 rout sends stocks, bonds, and oil lower. We're looking at all these different asset classes coming down, getting beaten up, and nobody really wants to deal with this type of information because they don't know where to turn. What do I invest in? Where do I put my money? Should I invest in Facebook stock? Should I invest in any of the other FANG stocks? I'm not sure. I own the FANG stocks. I own 7 shares of Amazon. Where do I put my 7 shares? Do I put them in my pocket? Maybe. Perhaps under the mattress is even better. Equity hedge funds have returned minus 4% year to date. Looking at all of these different types of assets, you can see where this has gone, whether it's the emerging markets, whether it's gold, whether it's euro, and none of them have been able to perform at the level at which we're being told the economy is at. None of these. We're being told the economy is sky high. Everything is great. Jobs are being created. We're seeing more benefits today than ever before. And yet, things are doing terribly. Things are not doing good right now. We're looking out there trying to find some semblance of reality. And I'm just here to basically yell and scream and try to make individuals realize that. Oil has fallen 30% from its peak. You look at the banks, all the banks, global systemically important banks, they're in a bear market. You look at all of these other things out there that are potentially what people are trying to pour their money into, and it's not looking good. That's an absolute fact today, whether it is trying to spread your money out into emerging markets or anything else, they're all looking terrible. Oil is one example of that. Currently, as of this recording, it's at under $52 a barrel for the WTI. The Brent is just above $60 a barrel. Again, we're down approximately 30% from the peak. This is beneficial for individuals in that they can be able to get cheaper gas, of course, cheaper food, and everything in your life is going to become 30% cheaper, right? Well, no, of course not. They're just going to screw you over, and the refineries are going to make a hell of a lot of profit off of this type of spread that they're getting today. We've been told, there's always going to be a lead time in between this two, but we haven't seen the benefits of it. Yes, the prices have come down in gasoline, but have the prices come down in food? Have the prices come down in everything else in that global supply chain? Of course not, and they will not. It has to stay down for an eternity before they finally make their way around to bring the prices down. It's just not going to happen. It's just not going to be that way. They're always going to find a way to make profit off of you. And look at the airlines as an example. They charge us this fuel tax on top of it. And that fuel tax, even when the prices go down by 30%, the fuel tax isn't gone. They're not going to do that because, of course, that cuts into their profits. They're putting this here. They give you that sticker price. It looks very pretty, but that's not what you pay. Saudi Arabia pumps record amount of oil. We're being told that this is all because of one issue or the other. There's a glut 1 minute. There's a surprise level of inventory the next minute. Nobody seems to know. Nobody seems to agree on it. Regardless, this is what's happening. Saudi has actually produced an all-time record high amount of oil amid all of this tension that we've been seeing. That's not positive. That's not good for those working in the oil industry if they're going to continuously see the price of oil coming down. Look at individuals out there who will be in the periphery, so those jobs that are surrounding oil. In a lot of these markets, they're basically, some of these towns are nearly 100% focused on oil. If oil goes away, you got a big problem. You got these other cities out there that are heavily reliant on the production of car manufacturers, whether it's Detroit, whether it's Oshawa in Ontario. You see these places that car manufacturers leave, the whole place becomes a ghost town. The economy goes down and everything else is interconnected with that. You need something else to happen, but it doesn't occur overnight. The jobs might leave overnight, but it takes decades sometimes to rebuild from that. Very unfortunate the way things work. And this is what I see happening with oil should the prices stay subdued for a long period of time. I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel. So I do appreciate that very much. I just wanted to say, I wanted to thank each and every single one of you for your support here, whether it's through the thumbs up and the comments, or whether, that happens to be through PayPal, through the Patreon. Thank you. That's really it. If you want the financial education that you were not taught in school, these two books have it all. You get everything you need to know, the foundation, the asset classes, how to make money, and so on. Check it out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.